Hello and assalamu alaikum. Now, in this class, we will discuss the second requirement, that is evaluate and prioritize the risk of material misstatement, that is ROMM, to be considered in planning the audit of group. And 16 marks available for it, right? We already did a business risk question in our previous class. So let us start with this one, right? Probably 8 to 9 risks, audit risks are enough. Okay. So I met with the group finance director yesterday, along with the representatives from the group audit committee. We discussed the group activities during the year and its plan to expand uh, into further external international markets next year. Okay. Uh, th- they also provided me with some extracts from the project, consolidated financial statements, key performance indicators. Also provided you with some background information about the group to assist with planning the audit. Based on the analysis which I have done on this industry, it is appropriate for overall material to be considered based on revenue. Overall material need to be based on revenue. Okay. You will need to determine and apply an appropriate materiality threshold in your briefing notes. So here is the requirements we already looked at. Now, the group operates number of largest hardware stores within the domestic market. The store supply building and materials equipment to the public and builders. The Hammer brand is internally generated and not recognized in the consolidated statement of financial position. It is key to the group success. One of the group subsidiaries, Ranch, is a financial service company specializing in saving accounts and loans to individuals. Okay. Malat is a wholly owned subsidiary and operates the Hammer source. It generates the majority of the group income. Malat company owns 50 retail stores across the country. Malat, who has been involved in the phase that at the national hardware to be stored during the year, offering significant discounts and heavily marketing the brand in an attempt to increase the market share. So here we get another risk related to audit risk, that is might be revenue is not correctly recorded. They might mix up the discounts, vice versa. There might be a cutoff problems. So there is one audit risk. Ladder is an overseas subsidiary situated in the far land. The group obtained 65% shareholding in October exports for cash consideration of 82 million. The share purchase was financed using a 32 million bank loan within a variable interest rate, which was taken on in X4. Another audit risk that is related to the loan. If the loan is properly classified as per the financial instrument IFRS 9 or not. Okay, that's another risk we got. Then the purpose of the acquisition to expand the group operations in a new geographical market. This is the first overseas investment made by the Hammer Group. Ladder company owns 50 hardware stores in Farland. Okay, so the renovation cost, capitalization could be over or understated. This is the risk. Then the NCI accounting might be not correct. This is another risk. Okay, lease that proportion of the company share capital is government owned. The currency in Farland is the same as country in which the group is based. Your firm was appointed as auditor of Ladder company in X4. and several members of the audit team have traveled to Farland to become familiar with the company, its key management personnel, its regulatory environment. Farland does not mandate IFRS. Okay. Ranch Company is a financial services company of the group. Hammer Bank, its customers are mostly trade customers who obtain credit and loans to financing. Again, it's related to IFRS 9. Okay. Uh, then it's related to IS 37, the provision as you know. In last year, the financial service regulator has been investigated many banks for charging excessive fee. Loans, meaning that they can claim back the excessive loan they have been charged. Rent company has provided legal framework for more than 25,000 customers in respect of this, and the group recognition of provision of 20%, 22 million in its SOFP. Then we have to calculate some ratios and discuss on it. Okay. Um Exceptional items are those determined by manager to be non-recurring. In next five exceptional items relate solely to store enhancement costs, and detail is provided in Exhibit 4. Okay, the inventories include materials such as painting and decorating materials, timber, doors, as well as equipment used by builders planning to improve their DIY customers. Inventories are measured in accordance with IS2. We have some ratios given by the audit partner. Then we have store remuneration. The program is expected to cost 5.7 each. At any time, five stores are closed while the renovations are and necessary construction will take place. That's related to I-16 capitalization issue. Costs relating to the store investment, including the statement of profit loss, which are projected to be 65 million, will be separately disclosed. Okay. In addition to 65 million, 55 million will be capitalized uh, within property by financial year and including expenditure in relation to extending car parking facilities, construction new facilities and cafes, redecorations, blah blah blah. Then sales promotion. In response to action of major competitors, the group introduced several sales promotions. During the year, the promotions include heavily discounted products, buy one get one free offers, mainly apply to the group paint and wallpapers lines. The group, while not listed best practices corporate governance, they're still applying. Okay, that's good. Then we have some investment advice. The group is now considering further investment in the next few years, and the group audit committee asks your advice to provide the selection of target companies, etc. Okay, as a group finance director does not have the expertise to complete the conversion from file and accounting to IAS IFRS, they have requested that as part of the audit, your firm makes the necessary adjustments to apply the group financial statements. Well, that won't be appropriate because that will bring us into the capacity of management that we need to explain to them. Now, let us discuss about the answer and how to you know discuss how to do the prioritization of risk. So evaluation of audit risk. Right. So far, so good. Move on. Let's move on. So, firstly, the materiality. For the purpose of these briefing notes, the following overall materiality level will use to assess the significance of identified risk, and as requested, this has been based on the revenue of the company. So the benchmark is 0.5%, 1% of revenue. Okay, of revenue. That is the range should be between 2.25 million to 4.5 million. Okay, so the benchmark is only a starting point for determining planning materiality, and professional judgment will need to be applied in determining a final level to be applied during the course of the audit. This is an existing client. Okay, it's an existing client. Okay, this is an existing client and we have cumulative knowledge and experience of the Hammer Group. However, the purpose restructuring and pressure on the company profit margins in the year increases the level of risk in the current year. Therefore, materiality level has been based on 0.5% of revenue at 2.25 billion and has been set at 2.3, around 2.3 million. Okay, so due to restructuring and pressure on profit margin, the materiality level is 0.5% of revenue at 2.25 million, that is around 2.3 million. So far so good. Now my first priority regarding the prioritization of risk is exceptional items and unusual movement in margins. So the operating margin before exceptional items has improved from 19.4% in 2004 to 21.6%. Okay, and this is non-lined with exceptions. Given the group sales promotion, so due to sales promotion and sales war between the group and the Mallat company, price war, between group and competitors. Okay, it would be expected that operating margins would fall, but it would fall, but and this supported by fact that operating margin after exceptional items has reduced from uh, they're reducing from 7.5% to 7.1%. There is an incentive of overstatement of operating profit before exceptional items. Due to the executive director's bonus, it is permissible to disclose items as exceptional items, where this enhances the fair presentation of the financial statement. However, the determination of which items are to be disclosed as exceptional items is subject to judgment, and users to the group financial statements could be mislead if amounts are not classified. Okay, if amounts are not classified, if amounts are not classified, then okay, there is an incentive of overstatement profit before exceptional items due to a director's bonus. It is permissible to disclose, as I said earlier. However, the determination of which items are to be disclosed as exceptional items, subject to judgment, and users of the group financial statement could be mislead if amounts are not classified and disclosed in transparent manner. And consistency with the group accounting policy. In this situation, there is a particular risk of management bias and due to the executive bonus being based on profit before exceptional items. It is debatable whether the store enhancement cost should be presented as exceptional item as there are typically just part of normal operating expenses. Okay, it is possible that management has chosen to classify the cost as exceptional in order to maximize their bonus. Given the unusual movements, there is also a risk that profit is overstated, perhaps through deliberate accounting treatment such as accelerating revenue recognition or overvaluation of inventory. Overall, there has been a reduction in net profit from 6.2% in 2004 in X4 to 5.3% in X5. And this is as expected given the loan taken out during the year and the associated increase in finance cost. Capitalization of cost in relation to next my risk, now number two risk on the basis of priority is capitalization of cost in relation to renovation and extension program. So, the cost of program is material to the group. The total cost is $144 million, significantly exceeding the maturity threshold 2.3 million. Okay. There is a risk that capital expenditure and revenue expenditure may be misallocated. What is the risk? Risk is capital and revenue expenditure is misallocated. Okay. Leading to over or understatement of property, plant and equipment and profit. Renovation cost could include items such as decorating, which would be expense, while acquiring land, creating car parks and building extension work would involve construction of any new asset, and those costs would be capitalized. It is possible that management may misclassify operating costs as capital in nature to increase reported profits. Once the stores are ready for use, the assets which have been capitalized should be depreciated over their estimated useful life. With so many different types of assets being capitalized, there is a risk that their individual useful life is not appropriately determined, meaning assets could be over or under depreciated, leading to inaccurate measurement of assets and recognition of depreciation expense within profit. It is possible management may classify assets together or to justify longer useful life and thereby artificially inflate profits through reduced depreciation charges. Right? We are done with two risks, audit risks. Number three, Acquisition of ladder company. Uh, Fair value of net asset and acquired goodwill. So, for these all two, assuming that it is correct to treat ladder company as subsidiary, there are significant risk of material misstatements relating to accounting for the acquisition. Risks, what are the risks? Accounting of acquisition, accounting treatment of goodwill, non-current NCI, non-controlling interest, and assets and liabilities acquired. Acquired according to IFRS 3 business combination, all assets acquired and liabilities assumed in a business combination are measured at acquisition date, fair value, and are recognized separately from goodwill. There is a risk that not all acquired assets and assumed liabilities have been identified. There is a risk that not all acquired assets and assumed liabilities have been identified and that they have not been measured at an appropriate fair value. The fair value exercise is very subjective, increasing the risk of misstatement, and the fact that fair value exercise is subjective, increasing the risk of misstatement, and the fact that later company is a foreign subsidiary may mean that the identification of assets and liabilities would be more complex. Any misstatements in the assets recognized will impact on goodwill, meaning that non-current assets could be over or understated. Okay. Next risk. Classification of ladder company. Information is not provided regarding the value of ladder company total assets or about the goodwill arising on the acquisition. Acquisition, but the cost of investment in ladder company is material to the group. But cost of investment is material, right? And it is a material, a group wise. A ladder company has been treated as subsidiary in the consolidated financial statement, which would appear to be correct treatment given that group owns 65% of the company share capital, which indicates control. According to IFRS 10, consolidated financial statements and investor controls and investee, where the investor has power over the investee, exposure to rights to variable returns from its involvements with the investee, and the ability to use its power over the investee to affect the amount of the investor's return. The risk is that due to government of Ireland owing 35 of ladder company share capital, there may be some restriction on the group management exercising its power. For example, if under the regulation of Ireland, a shareholding 35% is enough to block decisions, preventing the group from truly controlling the operations of ladder company. In this case, consolidation is as a subsidiary would not be appropriate, leading to the misstatement of the consolidated financial statements as a whole. Right? So, Foden, then ladder company, use of parliament, national accounting standards. For the purpose of consolidation, ladder company financial statements must be reported using the same accounting policies as the rest of the group. Right? For consolidation, the ladder company ladder company statement must be prepared using same standards as group. As group using is ISIFRS. As such, there is a need to adjust the financial statement of ladder company during the consolidation process. This is an area of high inherent risk and control risk. Why so? Due to the inexperience of the group management when ensuring the consistency of accounting policies across the group companies, there is a risk that the adjustments may not be complete or may not be appropriate, leading to errors in the group statement consolidated financial statement. Right? Then provisions of legal claim. The provision recognized is material to the consolidated financial statement. The risk is that liabilities may be understated and profit overstated. Okay. If not all claims have been recognized within the provision of is not appropriate, the investigation into the excessive fee charged by the rent is ongoing. Therefore, it is likely more claims may arise. In addition, there may be a fine or penalty imposed by the financial service regulator, which has not been recognized as the provision. Again, understanding liabilities and overstating profit, there is a risk of inadequate disclosures in notes to financial statement as IS 37 provisions, contingent liabilities and assets, required disclosures, including a brief description of nature, timing, uncertainties, assumptions relevant to the amount recognized, and accrual may also need to be recognized in respect of legal costs associated with the claim. If this is not recognized, liabilities and operating expenses will be understated. So far, so good. Um, then further, it's related to inventory valuation. In inventory valuation, inventory is material to the financial statements. The group follows IS2 inventory by making inventory at the lower cost and net realizable value, but a risk of material misstatement arises due to the judgment involved in measuring the value of money due to sales promotion. The risk is that sales promotions which are being put in place due to the price war with the competitors, such as buy one get one free, could reduce the NRV product price below their cost if effective systems not in place to determine Where there is the case, adjust inventory valuation accordingly. Inventory could be overstated in value. Giving the incentive for management bias disclosed above. Right? So far, so good. I hope you get it till here. Finally, after that, you need to give the group conclusion on the audit risk. And that's it. I hope you get it. And I'll see you in the next section.